Welcome back to the FreightWaves Net Zero Carbon Summit. I'm John Kingston, the editor-at-large at FreightWaves. In order to have net carbon zero, you have to have a price of carbon. You ultimately need that value. No matter how virtuous a company might be, at some point it is going to do a cost-benefit analysis on the steps it needs to take to reduce its emissions of CO2. And to do that, you need that price. The carbon market is probably too far along to be called fledgling, but it is a market whose most important years probably still lie in the future. Here to talk about how carbon markets work and where they are today at the FreightWaves Summit is Lisa Street. Lisa is the Director of Global Carbon Pricing at OPIS. Full disclosure, Lisa is a former colleague of mine who started out as a market reporter covering refined petroleum products. Now she brings her analytical skills to OPIS, which is part of IH Market. And from her perch as the director, she watches the developments of the markets created by the burning of some of those products that she covered all those years ago. So Lisa, welcome to the FreightWaves Net Zero Carbon Summit.
Thank you, John. I'm so excited to be here. Thank you to FreightWaves for having me, and I'm pleased to be talking to you about net zero at your Carbon Summit.
So let's establish some very basic things because most of our audience probably is not aware of them. There is a price of carbon. It is quoted per ton, but after that it gets a little bit complicated. So here's the question I want to start with. Why would I buy a carbon credit, and how do I get in position to be able to sell one?
Yeah, great question, John. And you're right. The standard unit of carbon is 1 metric ton of carbon, and there is a vast range of pricing across multiple carbon programs. But there's two reasons that you would be purchasing a carbon credit. One, if you are a regulated entity under a compliance program, such as California's Cap and Trade program, or if you are a member state in the Regional Greenhouse Gas Initiative on the East Coast, or if you're participating in the European carbon market, these would all require you to take a look at your emissions to see if you are under the cap, and if you're not under the emissions cap, you would then go either into the primary carbon market, which is through auction at a regulatory agency where they auction their allowances, or regulatory, the government will give free allowances through a free allocation program to its compliance entities. So you can obtain these credits in the primary market, or you can take your business to the secondary market, where it is very heated and heavily and actively traded on very legacy and prominent futures markets. Our exchanges are trading carbon credits for all of these programs I just mentioned. So getting access to the regulatory programs or credits in the regulatory programs is quite simple. The infrastructure is sound and stable, and it is very liquid and traded with heavy volumes every single day.
Now, can I get a carbon credit by being a good boy, in the sense of being a company that really has a low carbon footprint? I know that I did some of the early reporting on the California Low Carbon Fuel Standard, which is, you didn't mention that, but is essentially a carbon market designed to try to drive down the price of carbon. And I could earn carbon credits by behaving in certain ways, by using fuels that had a low carbon footprint. So can these be earned, or are they just the kind of things that you can buy off of some kind of ultimately what the government put into the market?
Well, we're talking about two separate programs now. So the function of California's LCFS program is to reduce carbon intensity of fuels by a specific time. And the way you can do that is by blending more biofuels or less carbon intensive biofuels. And when you act in that way, or you behave in that way, and you're blending up lower carbon intensity fuels, you have the opportunity to create these high value LCFS credits. So yes, your behavior in that sense, by actively participating in reducing the carbon footprint of the value chain through your blending actions, does make you eligible to receive these credits, and then to go out and sell these credits to markets who maybe are having to some of the stakeholders who may be having some difficulty in reducing their carbon intensity in their fuels. Now, For cap and trade program, there are assistance factors, if you will, or free allocation of allowances to a certain degree to some of the stakeholders. There is an understanding in the regulatory agencies that it's going to take some time for new technologies, mechanisms, processes, and behaviors to be implemented so that emissions reduction goals under that program can be met. So in the meantime, to prevent carbon leakage, to prevent some of these producers from taking their business out of the state and just moving it elsewhere where they don't have to comply with carbon, the regulatory programs do what's called an assistance factor or a free allocation. And so in this way, you are getting, or the entity is getting some free allowances that will allow them a certain percentage of what they emit, whether that be from their static refinery emissions or static cement production emissions or static power production emissions, or whether that be from the emissions that are covered from when you burn that fuel in the tank. We call those in-pipe, tailpipe emissions. So some of these free allocations do take place. Now, that's not a behavioral thing. That is regularly reviewed with stakeholders. There may need to be an adjustment to these assistant factors or allocation programs.
Right, because I remember one of the earlier similar programs was not a carbon program, but I know in Europe it was either for a NOx, nitrous oxide, or sulfur dioxide, NOx, or SOx. And they put out so many credits, the government's released so many credits that the price just plummeted to close to zero. And what that really did was it disincentivized being a good boy. I'll use that term again. There just wasn't much value in cutting your emissions that much.
Sure, John, and I agree with you. There were a lot of stumbling blocks in early programs. We saw that over with Europe's carbon program and what happened with the price impact when they had abundance of allowances in that program. And that doesn't, as you say, incentivize folks to actually move forward with reducing their emissions or compliance because the cost isn't high enough at that point. They would rather just pay it and move on. But, however, after the early stages, there are ways in which regulators can kind of protect the supply and keep a more balanced market, and they can do this through a number of reasons, a number of ways. One, we talked about the primary market and how the regulators release these allowances through auction, so they can choose to reduce the amount of allowances available at auction. They can choose to postpone their auction, or they can choose to put any excess allowances in a strategic reserve, so that therefore if price ceilings are met or prices escalate beyond to an extreme that it's actually hurting economic activities or production, then they can then release these allowances back into the reserve. Or again, as I said, they can always take a look at their free allocation program, and they can determine, is it too much? Do we need to scale back? Or is it not enough at this point to help us to stay on target, and also to not drive business away? Like, you really don't want to drive businesses out and just cause a leakage of carbon emissions elsewhere. So there has to be some kind of balance, and these are some things that the agencies can do to kind of keep that supply in check.
Yeah, the market always prevails. It was interesting in the beginning. You mentioned, various robust markets, and they were sort of trading at different numbers. I remember being involved in an early discussion at Platts about carbon and whether Platts would get into the pricing of carbon. And one argument was this will never be a big deal because there'll be one global price of carbon. It'll be traded on some exchange. It'll be completely transparent. So what does a price reporting agency bring to the table? Obviously, your career shows that it brings quite a bit. So how distinct are the carbon markets? Is a ton of carbon in Europe priced at the same as a ton of carbon in California, or are they vastly different?
I love how you put that, John, and you're absolutely right. These programs are quite different in the way that they price. They are very robust, and they have proven to be effective. Cap and trade programs are effective at reducing emissions, and we can talk more about that later. But I have built a good chunk of my career on creating carbon pricing solutions, not just at the credit level, but also at the compliance level, and how to help transportation fuel companies evaluate their cost of complying with carbon markets, and then moving that value along down the chain, down the value chain, and getting that to the end user, which is where behavioral changes are supposed to take place. Now, looking at pricing structures over in Europe, which is the largest carbon market in the world, currently EUAs, that's European Union allowances, that's their carbon credit, that's trading at around $45 a metric ton. That is a robust number off of what we saw many years ago when the market price had gotten dipped so low that it seemed like the program was almost broken. So right now it appears to be working quite well, and the demand is so strong. The prices are, it's the highest traded compliance market in the world currently. Now, looking over at California, which is the second largest carbon market in the world, it is currently trading around $18 a metric ton. That's one credit.
That's a significant difference. I want to go back to the people I met with all those years ago and said, your whole idea that there's going to be one price of carbon is completely wrong.
It's as we delve into the carbon market world, we can see just how differing the mindsets are across governments, across countries, across industries, and even across just our people on what really should be the cost of carbon. So it's a large range, and that's just compliance.
So a lot of, you mentioned transportation companies, and a lot of trucking companies and other transportation companies are feeling their way. They're putting out statements regarding sustainability, but they're not really sure what to do here. There's any kind of movement to decarbonize diesel is they're going to use it. There's nothing that they can do about it. There's just going to be the recipient of government regulation, I guess, the target of government regulation. So let's say you were going into a major trucking company that's put out a sustainability statement and that they want to be all in on the whole move to decarbonize the economy. What do you tell them? What does the kind of services that you do, how can they use that without, remember, these companies are, they're not tiny, but compared to like big gigantic utilities, they're small, and they work on fairly tight margins. What does the price of carbon do for them with their goals?
Right, and that's a wonderful question, John. And I think that what I'm going to do is kind of evaluate this from strategies that I have already seen employed by different industries, and we can talk about that impacts in the terms of price. So we've got short-term and we've got long-term solutions. What we've seen from the energy industry is a robust call to move and to expedite the transition. Every day we are seeing calls from big major oil companies and also big financial institutions on how many billions of dollars they're going to be investing in creating a carbon neutral economy. So the trucking industry is not, is no different. They are a major player. Transportation fuels is the largest component of emissions globally. So we do have, it is something that needs to be addressed. Now, in the short term, a short-term solution, and what many in the marine fuel shipping, bunkering services, and transportation fuel delivery services, just typical LNG deliveries or even oil deliveries. You can, what we're seeing is the utilization of carbon offset credits, bundling of these credits to create carbon neutrality for clients. That could be a strategy in fleet and in transportation and in moving product. E-commerce was huge during the pandemic, and our trucks were rolling like never before. And so and that was good for business there, but also we saw a lot of emissions to that. So one solution could be to see if there's a page that you can take out of the transportation fuel sector, or even what we're seeing happening in shipping and maritime shipping. Is there an opportunity to provide your clients with carbon neutral delivery solutions? And can you do that by getting involved in the voluntary carbon market, purchasing offset credits, and letting your client know that you are going to show them proof that you are retiring credits on behalf of your vehicle mile travel in this journey? You can estimate your vehicle mile traveled, estimate your emissions during that time, and discover how much offset credits. Now, that's going to when you're creating carbon neutral deliveries, that's going to result in a premium. But again, this is another cost that has to be considered in the value chain and how that gets to the end user.
But in the absence of, let's say, a transportation company being part of some sort of, you talked about the regional greenhouse gas group up in New England. It's not just New England; it's the whole Northeast. In the absence of a carbon tax, in the absence of any kind of a mandate, in the absence of a company signing on to that kind of a pact, what is the value here? Is it just simply good governance? Is it doing nice, or is there another value?
Oh, yes, John, there is a huge value. It's great governance. Of course, it's great governance, but also companies are responding right now to a hyper trend in investor strategies that is leaning and targeting holding carbon conscious portfolio, which means that they want to invest in companies that are taking the steps to reduce their carbon footprint, who are taking the climate challenge seriously. And if you just take a look last week, I saw 2 announcements from major banks who were hundreds of billions of dollars to be invested in these energy transition and carbon neutral strategies. So investors are moving this ball along, and it's creating boardrooms who are environmentally conscious, who are taking a look at their ESG targets and deciding what's going to be my strategy for reducing these emissions. Is it going to be something in technology? Am I going to shoot the ball in the long term? Am I going to seek investments in carbon capture and sequestration? Do I look at direct air capture methods, which, by the way, can produce carbon credits out in California's LCFS program? So if you're looking to scale up your investment there, that's about $200 a credit. So, I mean, and that will help some of this investment along. So you can do it through technology. Maybe they're looking at renewable fuels. Maybe they're looking at alternate fuels such as synthetic fuels or renewable fuels, or in the short term, what we're seeing is the application of carbon offsetting right now at prices in the voluntary carbon market that are between, you can get them on average anywhere between $1, John, up to $20. So you can pick the range for these carbon credits that are issued by industry renowned standards that have been widely accepted across the board, that say this is a high quality credit. Now, the prices in the voluntary carbon market are differentiate depending on what project you're purchasing from. Is that credit coming from a renewable energy project? Is that credit coming from a nature-based solution such as a reforestation project or afforestation project, which might hold a little bit higher of a price tag, because those type of projects tend to have additionality. They tend to have more benefits tied to them. But in that price range of $1 to $20, I mean, in my pricing, I'm capping out at $8.50, $9 for some very high quality Red Plus credits with additionality and benefits. And this is an area in the short term that that stakeholders can play in, and that they can effectively use to begin right now reducing their carbon footprints, why they are gearing up for those midterm and long-term solutions that are more revolved around technology and differentiating of fuel usage, and whether it's fleet renewal programs or what have you, electrification, getting there, right? So It's a short-term strategy. It can be applied, and we're seeing it now. You asked me, we were talking the other day, and you asked me if I'm seeing commodity or traditional commodity trading houses engaged in this market. Yes, John, absolutely. I think I saw last week multiple trading houses.
We only got a minute or two. So let's follow up on that. Is there,
Sure.
okay, so the big commodity trading houses are getting into it. That's good. It provides liquidity, which provides transparency. Are there any exchanges? I mean, I shouldn't say, are there any exchanges? I know it has been attempted on exchanges in the same way that I could go out now, right now, and look at the price of oil on an exchange, the price of copper. Can I go out right now and get a price of carbon on some exchange?
You can go to one exchange and you can get a price of, well, in voluntary carbon, if we're talking about voluntary carbon, but you can go to one exchange. There is one contract right now that has three standards or methodologies that are eligible to meet the Corsia
And what
program.
exchange is it on?
That's CME.
It's on CME, okay, which is the
CME
same
has a
place where
contract.
they trade oil and they trade diesel and trade lots of other things.
There's one, but that being said, that's our traditional. But I will say this without plugging anyone's current business here and being very fair in this market. There are electronic tokenized exchanges in Singapore where you can buy and sell project credits, and that could be a nature-based solution, it could be a technology solution, it could be a Corsia eligible offset that has been approved by ICAO's regulatory board. And that that you're getting a quality credit that way. There is another commodity trading platform here in the U.S. that specializes in bilateral spot OTC trading of voluntary carbon markets, which is quite active right now. And I'm seeing from this one particular person new developments. I've seen two new developments in the past quarter. So I mean, it's heating up out there, John. But the good news is that trading solutions are coming to the market, and that's what's going to help improve liquidity, improve volume. But we really need to work on creating risk management solutions so that we can improve investor confidence in this market. There's a lot of uncertainty around double counting and double claiming, and that makes a lot of people hesitant to want to get involved in the market.
With that, we're going to have to bring this tremendous interview to a close. Our guest today has been Lisa Street. She is the Director of Global Carbon Pricing at OPIS. She's been talking about carbon markets at the FreightWaves Net Zero Carbon Summit. I've been your host, John Kingston. I do want you to stick around. We've got a lot more discussion on this important market.